Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Insteel Industries Inc. quarterly report. Insteel Industries Inc. offers a range of steel wire reinforcing products for concrete construction applications. The company's primary product lines include prestressed concrete strand, PC strand, and welded wire reinforcement, WWR. PC strand is used to provide compression forces into precast concrete elements and structures, while WWR is utilized in both non-residential and residential construction. The company produces a variety of WWR products, including engineered structural mesh, concrete pipe reinforcement, and standard welded wire reinforcement. Engineered structural mesh is a made-to-order product that serves as primary reinforcement for concrete elements or structures, replacing hot-rolled rebar. Concrete pipe reinforcement is used as the primary reinforcement in concrete pipes, box culverts, and precast manholes for drainage and sewage systems. In addition to these products, Insteel Industries Inc. also offers standard welded wire reinforcement, which is a secondary reinforcing product for crack control applications in residential and light non-residential construction. The company sells its products through sales representatives to manufacturers of concrete products, rebar fabricators, distributors, and contractors. The company's product offerings cater to various industries, including construction, infrastructure development, and water treatment facilities. With a wide range of steel wire reinforcing products, Insteel Industries Inc. is well-positioned to meet the needs of its customers in these sectors. In summary, Insteel Industries Inc.'s business services include prestressed concrete strand, PC strand production, welded wire reinforcement, WWR, production, engineered structural mesh manufacturing, concrete pipe reinforcement production, standard welded wire reinforcement. Manufacturing. The company's products are sold to various customers in the construction, infrastructure development, and water treatment facilities industries. Insteel Industries Inc. has experienced a significant surge in its stock price over the past year, with a notable increase of 26.32%. This growth can be attributed to several key factors that have contributed to the company's financial success. One major driver of Insteel's increased stock price is its strong quarterly earnings reports. The company has consistently reported substantial increases in net earnings and sales across multiple quarters, with gross margins expanding significantly. For instance, in the first quarter of fiscal 2026, Insteel reported a substantial increase in net earnings to $7.6 million, or $0.39 per diluted share, compared to $1.1 million, or $0.06 per diluted share, in the prior year quarter. In addition to strong quarterly earnings reports, Insteel's improved profitability and margins have also played a crucial role in its stock price increase. The company has demonstrated an expansion in gross margin across multiple quarters, attributed to wider spreads between selling prices and raw material costs, higher shipment volumes, and improved operational efficiencies. Furthermore, the company's strategic acquisitions have contributed significantly to its increased sales and shipments. Insteel has consistently highlighted favorable demand trends in the infrastructure and commercial construction markets as key drivers for its increased sales and shipments. This demand was often linked to projects funded by the Infrastructure Investment and Jobs Act, IIJA, and a booming data center construction market. Overall, Insteel Industries Inc.'s stock price increase can be attributed to a combination of strong financial performance, strategic growth, and favorable market conditions. The company's ability to adapt to changing market trends and capitalize on opportunities has enabled it to deliver a 36.48% change over the past year. Insteel Industries Inc. market capitalization of $1 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Insteel Industries Inc. holds a significant advantage in their industry. Insteel Industries Inc. trades at a lower price-to-earnings ratio of 14 times and a lower price-to-book ratio of 1.79 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include net sales from strategic acquisitions, leadership positions in markets, cost efficiency, and pursuing growth opportunities within core businesses. Additionally, favorable demand trends in infrastructure and commercial construction markets, as well as strong customer sentiment, have also contributed to revenue growth. On the other hand, revenue decline is driven by factors such as restructuring charges, acquisition costs, contractual discounts, and credit losses. Soft residential markets and significant steel price premiums in the U.S. relative to global markets have also negatively impacted revenue. It's worth noting that some factors, such as customer payment terms and credit losses, are estimated and may not be entirely accurate. Overall, a company's ability to adapt to changing market conditions, manage costs effectively, and make strategic acquisitions can significantly impact its revenue growth or decline. Net income experienced a significant surge from $1.1 million to $7.6 million, marking a staggering 587% increase. However, this upward trend was short-lived, as net income declined in Cone 2026 without specific details provided. The fluctuations in net income can be attributed to various factors. In the initial period, the company's gross profit likely contributed to the substantial increase in net income. Additionally, lower restructuring charges and acquisition-related costs may have also played a role in boosting profitability. In contrast, the decline in Cone 2026 could be linked to changes in working capital and inventory levels, which may have had a negative impact on the company's overall profitability. Despite this setback, the initial surge in net income suggests that the company was able to capitalize on certain opportunities, leading to a significant increase in its bottom line. The company's operating cash flow has experienced fluctuations over the past 2 quarters. In Cone 2025, the company generated a positive operating cash flow of $19 million. However, this trend was reversed in Cone 2026, where the company reported a negative operating cash flow of $701,000. This inconsistency raises questions about the company's ability to sustain its financial performance. Management is optimistic about the company's outlook, citing strong financial position and a revolving credit facility that provides flexibility for working capital and growth requirements. The company expects to realize synergies through integration of acquired assets and anticipates higher shipments and profitability in the 3rd and 4th quarters due to seasonal weather patterns. In terms of strategy, management emphasizes the importance of maintaining compliance with all financial and negative covenants under the credit facility to avoid events of default. This includes managing cash flow and liquidity to meet short and long-term requirements, as well as curtailing capital and operating expenditures if necessary. Looking ahead, management is confident in the company's ability to deliver strong performance in fiscal 2026, driven by customer sentiment and demand across core markets. Non-residential construction remains a key demand driver, supported by infrastructure spending and data center activity. The company will focus on factors it controls, including expense management, synergy realization, production scheduling, and productivity improvements. Management also sees opportunities for future growth through investments in facilities and plans to continue making investments for reduced operating costs and additional capacity. Additionally, the company is evaluating acquisition opportunities to enhance its presence in current markets or expand its geographic footprint. Overall, management's strategy is centered around maintaining a strong financial position, realizing synergies, and investing in growth initiatives. The company's financial activities have been quite active in recent times. one notable aspect is its commitment to rewarding shareholders through dividend payments. As per the records, the company has indeed paid out dividends, indicating a strong focus on shareholder value creation. In addition to dividend payments, the company has also taken steps to optimize its capital structure by buying back shares. This strategic move allows the company to return excess cash to shareholders and potentially boost earnings per share. By doing so, the company demonstrates its confidence in its future prospects and commitment to delivering long-term value to its investors. That concludes the financial summary for Insteel Industries Inc. Feel free to comment below, and I will be happy to answer them when possible.